The stock market had a scintillating first quarter, but stocks have cooled off a bit, and now people are worried whether or not this might be the beginning of a dreaded correction, if you will. Here to talk to me more about that, J.J. Kinahan, the Chief Derivative Strategist at TD Ameritrade.
Hey, Paul.
Earnings, we're about to have the onslaught of corporate results. People are a little worried that maybe the numbers won't be that great. What do you think about that?
Well, if you look at what's happened so far in the earnings, we've had a pre-warning by just over 120 companies so far, and 58% of them have warned to the bad side. So combine that with the fact that in the last earnings calls, a lot of the CEOs actually dampened earnings expectations also. So I think that the expectations are low, and if we can get a 2.5% to 3% growth out of a lot of these companies, I think they'll do just fine. Obviously, Alcoa will tell a lot of the tale as the lead stock today, but it's just kind of interesting to see that yesterday we didn't really see the follow-through I would have expected if there was really a huge threat to the downside.
Right. Alcoa kicking earnings off. They'll be reporting after the bell Tuesday. We've obviously got Google, JP Morgan Chase as well this week. I think a lot of people are just wondering, though, whether other than a little company that's synonymous, I think, with everything,
right.
Apple, a lot of people wondering whether or not the earnings growth really is going to be there for major companies other than Apple. I mean, what's the bull case, if there is one, for earnings if you're not named Apple?
Well, Apple's almost its own stock market at this point, isn't it? But I think that really the financials will be kind of interesting. You know, one of the things that gets lost in the shuffle of all this, mid-sized banks have actually done fairly well. And I know that that's maybe not really exciting for a lot of people, but they're a sector I like to keep my eye on because as they are healthy, that really tends to be a nice telltale sign for the rest of the economy.
To wrap up, I'm wondering, what are your thoughts on whether or not stocks, particularly maybe tech stocks, really do need some sort of correction? I mean, the NASDAQ up almost 20% in the first quarter.
Right.
I think for anyone who's been doing this for a while, that's eerily reminiscent of the late 90s, 2000. Now all of a sudden you have unprofitable companies like Yelp going public and doing well. Instagram, with all of 10 workers, gets bought by Facebook for $1 billion. It may not be a market bubble, but is there a tech bubble, or even more narrow than that, a social bubble?
Yeah, I was going to say it may be a little bit of a social media bubble. I could certainly listen to the case for that. With Apple, you read, I mean, it has been incredible. You read their expectations, though, for earnings. People are still pretty bullish on what's going to happen to their earning. Kind of interesting. I saw an analyst yesterday actually take Apple off the buy list down to a hold.
Right.
You'd have thought he said that the stock was going to zero, the way people were reacting. But even he said in his letter, he thought that this was going to be a blowout earnings. So, what does that mean? Does that mean we go to 900 first? Or it's tough to. If you look at the chart, if you look at what's going on, it's certainly tough to go short Apple. Now, if you hold a long position, I think to not sell calls or buy some protection, or maybe just lighten up a little bit, particularly for the retail investor on some of your position, might be smart. Bears and bulls make money, pigs get slaughtered type thing. So there's nothing wrong with taking a little bit of money off the table.